Hi, and welcome to Loan Officer School. This is your How to Calculate Income training session. Once again, I'm Charmaine Lane. Please call me Char because the toilet paper jokes got old by the third grade. And you can always reach me at charmaine@loanofficerschool.com, and you can call our offices at 866-623-1250. Once again, visit our website at loanofficerschool.com. We've got lots of programs and products and audios and videos that can help you be a better loan officer. All right, income. Most primary types of income that you're going to ever have to calculate are those off of W-2s, pay stubs, tax returns, and a few extra things that you need to look at when it comes to self-employed borrowers. Now, step number one is looking at a borrower's W-2. A whole bunch of numbers on it, but what are you really looking for? Well, you're going to need 2 years of W-2s, so make sure that you're always requesting at least a minimum of 2 years. You're also going to be looking at box 5 for Medicare wages and tips, because this is how much a borrower actually earned. But what they paid in one of their other boxes is what they were taxed on. Remember, if you're contributing to some type of an IRA or a 401k that is done pre-tax dollars, you made this money, but you may not have paid taxes on it because you put it into some secured account. So that's why you're going to be looking at your Medicare wages and tips box number 5. What you're going to do is look at both years of your box 5 for the last 2 years of W-2s. You're going to add them together, and then you're going to divide by 24 months to come up with the average. This is going to be your monthly qualifying income. Now, sometimes lenders are a little bit generous, and they'll let you qualify just off of what the borrower's current salary is. But if you've got commission, bonuses, anything else, irregular overtime, you're going to have to use the average for those amounts, because sometimes the dollar amounts can be inconsistent. So you want to make sure that the borrowers are using the average amounts if it's some type of, again, commissions, overtime, bonuses, things of that nature. So this is what some W-2s look like. Now, depending on who your provider is, your payroll provider is, they are all going to look a little bit different. So what you want to do is just find box 5. It's going to be located somewhere differently on every type of W-2, but you're going to look at some general information. So right here, we've got a borrower who made $42,724 that year, and this is in the year 2003. This is just a sample example here, so don't worry about that. Their years 2003 and 4. This is just a made-up W-2. All right, and then you've got another year of 2002 of $51,158.59. So what we're going to do is add those 2 years together, or those two amounts together, sorry about that. We're going to add up that amount, we're going to add up that amount, we're going to take that total, and because it covers 2 years, we're going to divide it by 24. Now, sometimes you're lucky enough that a lender will allow you to use the current pay stub and average that amount with just the last year's W-2. If that's the case, you're going to be looking for the period ending date and divide by the number of days in that month. Then you're going to take the total number of months that the pay stub covers, and you're going to divide that total by the total number of months. You're going to find the year-to-date gross amount and divide by the total number of months that all equals. So let me show you a little bit about what this looks like. So first off, what we've got is period ending date. So this says August 20, 2004. All right, so that's the last time that borrower's pay period was calculated. So this pay stub covers how many months? Well, all of January through July plus 20 days of August. You don't want to divide it by 8 full months, right? Because you don't have a full month of August yet. Now, if this was dated August 31st, easy. You just divide it by 8 to cover all 8 months of that year. But in this example, this pay stub doesn't go to the end of the month. And most often, borrowers get paid in the 1st or the 10th or the 15th or somewhere in between. So this is why you need to know how to read a pay stub. What you're going to do is you're going to, again, first look at your pay period ending so you know how many days or months to count. Then you're going to look at the year-to-date gross wages. So in this example, it is $99,900. So that's the total year-to-date gross wages. So this means within 7 months and 20 days, the borrower has made $99,900. So let's just say that we've got the W-2 of the prior year. So let's say we have a borrower who's made $42,742 all through the prior year, and they've made $99,000. Wow, they've had a big pay increase, huh? So $99,900 through the current now year. All right, so that's a total of $142,624. Let me see if I can remember it. I'm just going to round that up to $142,000. So now I need to know, how much time does this cover? Well, first thing I'm going to do is go, all right, well, what percentage of August have we covered? So 20 days. 30 days has September, April, June, and November. All the rest have 31. So August has 31 days in it. You can also just look at a calendar, but I don't happen to have one handy. So I'm going to take 20 days and I'm going to divide it by 31. So this pay stub covers all of January through July, which is 7 months, plus 0.64 of August. So now I'm going to take 12 months, because all of the prior year plus 7 point, let's just call it 60, that's going to equal 19.6 months. So I'm going to take that total of $142,000 and I'm going to divide it by 19.6, and that means my borrower's average income is $7,244 per month. And that is how you look at a W-2 and a pay stub to calculate income. Now, that's not too hard of a formula. You just have to remember which pieces and parts or what pieces and parts. Most important thing is pay period ending, your year-to-date gross earnings, and to make sure you're doing the math properly on the number of days covered in that month, so that way you have plenty of time or plenty of money to calculate the borrower's debt ratios off of. All right, now that takes us to tax returns and red flags, things that you need to pay attention to. On an individual's tax returns, if they are self-employed, you're generally going to be looking at the line 36, which is the adjusted gross income. You're going to take that number and divide it by 12, and that's going to give you the annual income for that borrower. Now, some of the things you're going to be needing to look for on a tax return is if the borrower is paying alimony. Now, borrowers have what I call selective amnesia, and they may not tell you that they owe alimony every month, but once you get their tax returns, it shows on there that money is being paid or alimony is being paid to another Social Security number, and that unfortunately is going to be calculated into the borrower's debt ratios. So that's another reason it's important to get tax returns, to make sure that there's no hidden debts that the borrower didn't accidentally forget to tell you about. All right, and then if there is if page 2 is available on line 36 of the borrower's most recent 1040s has an amount higher than the standard deduction, you want to make sure that you're looking at Schedule A, because they might be writing off things that could affect their ability to get the loan. All right, so this is just a little bit of specific details on each section of the tax returns, so I'll let you read that on your own. Now when it comes to looking at a borrower with self-employment, again, what type of self-employment are they? If they're a sole proprietor, they're just going to file everything on their own 1040s, but if they are a partnership, an S Corp or a C Corp, you might have 1120s or any other type of an additional report or a return, so you got to make sure that you're getting all the necessary documentation for each of your borrowers. All right, the next worksheet is going to help you analyze what are positives and what are negatives. So you're going to be looking at certain different schedules, K1, Schedule C, F, 2106s, all of these different things that don't really mean much to you if you're not an accountant or a tax preparer, but they are going to become important to you when it comes to your mortgage careers and calculating income properly. So this is a great little sample form that you can use. It gives you the total, so it just tells you to enter in the dollar amount there. Wages salary, so it's going to tell you to subtract this information here. Tax exempt income, you're going to add in that information there. You're going to take state and local tax returns and you're going to enter in all of this information. What's great is all you have to do is read these things. You're going to find that same definition or line on the tax returns. You're going to fill in the amounts here, and then you're going to subtract this one, add this one, subtract this one, subtract this one. Depending on if it's an income or a loss, you're going to just add or subtract that one, and then go all the way down until you get your final answer. So it's a pretty handy-dandy little tool. Now it goes through each section of the tax returns, which makes it even a more handy worksheet to use. So again, Schedule B, your interest and dividend income, you get to subtract that out. Schedule C, you're going to do your plus or minuses here. Tells you what to look for on Schedule D. Again, if you have a form 4797, 6252, or Schedule E, you're going to go here. All right, and then each one of these items is a description of what goes into each section. You've got a Schedule F and information on partnerships, which generally would be a K1. All right, partnership information on a different form 65, 1065, or corporation income, which is an 1120S if it's an S Corp. All right, regular corporation, again, a form 1120, and this is how you're going to fill this out. So this is going to be a really great calculation and a great sample, just a little sample worksheet to help you find out exactly how much you can use for this borrower to qualify. And again, a few additional pieces of information just to read up on a little bit later so you know what each section means on the credit report, on the tax returns. Now, a profit and loss statement is generally going to be required on all self-employed borrowers to make sure that they're not running their business today lower than what they were at on their prior year's tax returns. So income is going to be everything that you are deriving your income over here, and these are your expenses, everything that comes out. Now, most people know that people who are self-employed or run their own businesses, they write off the sun, the moon, and the kitchen sink. So as you see here, accounting. Well, most people might have an accountant to prepare their tax returns, but they don't get to write it off simply because they don't run a business. What about advertising or assets or electricity? You don't get to write off the electricity in your home, right? But as a business owner, that's an expense, and yes, you can. So these are, again, things that basically you're saying on your taxes you have to pay in order to run your business. That's why they are taken out of your gross income when it comes to running your own business. So you've got to subtract all your expenses from your income, and you are able to qualify on the amount that is left over. All right, so again, for all your other bonuses, commissions, this is just a breakdown of all of the information. You can read it on your own time, but again, it just gives a little bit of an explanation of each section of the tax returns or specifically broken down details on each section of the loan application so that you know what certain types of income is and how to calculate it. All right. That wraps up our section on how to calculate income. Make sure you go back and read all of those other fine details so that you know what goes where on applications and when it applies to your borrower's loans. Thanks again, and we'll hope to see you at a future event.